The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi folks, Basil Chapman, Tiger Technicians Hour on this Monday, Marathon Monday here in Boston. And it is a kind of cool, chilly-ish day. Should be rain coming in about an hour. But everything's going along, and a little headwind, I believe, at the beginning. Just watching here, I haven't really kept up very much. It's such an interesting market day. Now, let's just get right to the story. Say thank you to John Logan, Steve Rhodes. Great few hours we've had. This is really where the market, this is where the real day starts. The short covering has been completed to a large extent. Now we're going to see whether the new buyers come in or whether the institutions say, okay, enough of this whipsaw, let's get back to reality, and we'll see what they do. Two things are very important today. One is that if we're looking at the E-mini contract, which is up 21.25. Now remember, on Friday it was a very sharp down day. At one point the Dow was down 350, S&P was down huge, and then there was a comeback towards the end of the day. So that while the Dow and the S&P and the other indices, New York Stock Exchange, had a balance. There was still some selling at the close, but we were way off the low. Two things happened at that particular time. Because the close had a rebound, the technicals, the daily technicals on the E-minis, the MACD held quite well, and the stochastic was still above, it's at 83%, so it was well above 80%, and that was pretty much the same for many of the indices. That said to me that what's very important about today is how both the volatility index reacts and how the market closes. That's, to me, those are absolutely the two imperatives. So this is all part A. Part B, the second part of the whole thing, is that within the context of rotation, will the biotechs, the XLV, the healthcare sector, will the sectors that were so strong before and have really been struggling, how will they act and react if there was any rally to the upside today? And will there be some kind of rotational focal point that says, hey, you're looking at the wrong things here. This is one of those sideways moves. Let me just go back to this chart here, which I always show my Dow Daily, which I show my subscribers. There was a terrible failure on Friday. Look at that candle right there. But I'd say to subscribers, note that we've done this before, and that as you're getting closer in the Dow to the 17,600 area, that's where sometimes you can expect a really sharp rebound. So that makes follow-through selling or follow-through buying very, very important. The aspect of follow-through buying says that if, perchance, I don't even think you need to close above it, but if you break the high of Friday, that was at 18,102.56. If you break above it, you would have to fail miserably underneath the 9-period exponential moving average of 17,991 to really establish that that was a failure pattern. Because if you break above it, it says, hey, I've only got 18,170. At that point, I just need a little spike and I can start making leg D, and that dashed target inside wedge, Chapman wave inside wedge target line, rising target line, says, hey, we can still make it. I just don't think that there's enough strength. And this is interesting. I've got 78% in the stochastic in the Dow. Now, on Friday, let me go to that because I meant to mention it earlier that there was a slight divergence between the S&P. There we go. The S&P. Yeah, very interesting. I have so Friday let me just get to it. Friday the slow moving average was 81.98, so it was over 80%. And let me just double check here. Slow moving, yeah. No, 74. So that 74 was not a good sign. And 74 and 78. Yes. It was in fact 81.98, a slow D, and now we're looking at a situation where it is 78%. So this is interesting that the market is up strongly, but the slow-moving average has not been able to flatten out. All right, so we're going to keep watching this till the end of the day. More importantly, then. The weekly chart, look, we were so close. The weekly actually gave a sell signal. That's just what that says is that the price has gone in a certain pattern and then closed underneath the 9-period exponential moving average with the technicals quite weak. So what I'm looking at here is that there was a trigger, and trigger was maybe China saying they're going to push more money out. So the FXI, I wonder what happened there. FXI has spiked higher. It's up 0.83, up at 0.42, at 50.45. Still made a peak F the other day on Friday. So once you see that happening, once you see that there's a response in international markets to some, in a sense, it's external event, but it really is internal because it's saying, hey, money's being pumped, money's going to flow through the different countries, stocks, stock indices, and that's the support. So here's the other thing. Within the context of that sideways move, and we've really been going sideways since, look at this. Let me open this out a little bit. Look, you've been going sideways since February. There was that one spike down to the 17,034 level, but basically the 17,500s to the 18,200s, we've been in this range for the whole year, just about most of the year. And one of the things that I always talk about is that a rectangle formation, and now we're really starting to form something like, let me just do this, I'll overlay it to show that we're really in a kind of a rectangle formation. Look at this. There, the dark, the shadow is the range. And when you're in a range like this, what you want to understand is that as you get to the top, you got to get ready to short, and as you get to the bottom, you got to get ready to go long. And we, in fact, we're shorting. Now, it's very interesting. We've got a pretty diverse portfolio, a real mix of longs and shorts. Within that context, it's more individual stocks rather than just indices. And I'm looking at that as saying, because of the whippiness in this range-bound, sideways, bouncing yo-yo type go-kart market, just ricocheting from one level to the other, it's individual stocks that probably are going to do best of all in your longs and your shorts. So that's kind of the stance we've taken at this particular point. So now let's go back to some of the story. Let me just give you all the numbers. Here we go. The Dow is up 249. That's impressive. We're at 235. I was saying, okay, are you going to break down? But when you popped up just moments ago to 260s, and now you're at 250, I just have to say, within the context of what we're looking at, that is a pretty decent inside day so far, and a really good get back of almost all of Friday's loss. Very, very impressive. And that Dow chart has got a peak D in the weekly, and it's way up at 18,288. Monthly chart, as I said to my subscribers over the weekend, sent out a half dozen or more charts, and I said, hey, that's what we're going to be looking at, because the monthly chart hasn't yet given any signals whatsoever. So the sell signal is just to describe. It's not ascribing a character, it's describing a price point. And that says that if the Dow weekly breaks this trend line here, that's going to be very negative. It almost did it on Friday. It held it and then bounced. And look, today you're way above it, above the 9 EMA. Whippy action continues. My bias is still to be looking at this as a consolidation phase. Now let's go to the next thing. And the next thing is, so the Dow has the parameters that I'm watching near term. 17,989 is major support, and a break above 18,105 would be impressive, and say, hey, you can now make a leg D over 18,045. Okay, now the next thing we're going to be looking at is the S&P. Whoops, let me get there. SPX.X. Okay, it's good. And what's really important about it, it's not quite the same as the Dow, because it did not close underneath the 9-period exponential moving average of Friday. And the other thing is that the daily chart, stochastic and MACD are okay, but the price actually is trying to challenge that inside track declining resistance line, and it's gone above Friday's opening shot of gap down, which was at 2102.58. We're right now at 2102.08, having gone all the way to 2103.94. That is impressive. So let's keep that up and say that we've got a peak C1, C2 in the weekly charts. The big thing is, will the S&P be able to break above 2110? That's really important. 2111. 2111, that's impressive. So far, good action, but I'd like to see what happens during the week. Okay, QQQ I'll go to, because the comp index right now is up 20 at 21. The comp index is up 56, I believe, at 49.88. Now, this is going to be very important. The QQQ is at 107.44. I believe I said to subscribers to my opening call this morning. I also list in my Traders Corner, I give all the parameters for the what to watch for, support, etc., for many of the ETFs, like the QQQ, which we don't have a position in, or the TLT, which we don't have a position in, or the VIX, etc. So it's a very comprehensive report that goes out every day. Now, I've been unimpressed at all with the QQQs. At this particular point, the weekly chart, came back very nicely, but the daily chart is really struggling. It's making lower highs, not yet lower lows, but it is lower highs. Going to be watching this closely. It really is to take out 108.20, which is another 80 cents above this. So at 107.43, up 142, good action, not yet great action. So let's go to the IWM. IWM, there we go. IWM, peak C, G/C. We're going to see if it actually makes a E. The weekly chart says it's probably a peak F, unless later in the week you can get to 126.33. It's a 125.76, up $1.33, which is good. But you're going to be watching it closely. Basil Chapman, Tiger South, give more of the indices.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economies CD. This is a CD that could really deliver, but you have only until May 7th to take advantage. Consider the facts. If the Future Economies currencies beat the US dollar over the CD term, you'll get all of the upside. And should they lose? No worries. There's zero downside risk here, as you'll still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. Just during the break, I had a question about Cyber, which is CyberArk Software Inc. Done fabulously. It's trading at 61.26, made a peak E in the Chapman wave methodology at 63.88 on the 16th of April, pulling back a little bit. Peak C in the weekly, and it's working its way trying to get back there, and the monthly is only at B. I do believe I better write this down here. Cyber, put it over here, Cyber on a watch. The next pullback I think might be worth watching closely. It looks to me like in the monthly chart at some point it'll go back to the 70s. Right now it should be consolidating. You know, I wondered about the move on Friday. How much of it was institutional? How much of it had to do with what the layperson is considering? After all, it's worked for the institutions for so long that every single decline was worth buying. My thinking on Friday was, I will only know by Tuesday or Wednesday whether or not this was the layperson grabbing stocks at the end of the day and being very well rewarded today if they did that. And what does it mean if there is a sudden slide as we're up at the top of the range, going back in the rectangle formation towards the bottom of the range? What will it mean to them if, in fact, this time we start to break to the downside? So watching that real closely. Another question I had was a yang. Was that yang? Fang. You got all these yangs and fangs and whatever. So this is Fang. Nice move. Diamondback Energy made a peak C in the monthly, up at a 93.33 level in June, pulled back a lot. It pulled back to 51.69. I mean, that is a 40% decline. Now it's running so strong. It's at 84.73. Looks like it's going to make a leg D at 93.34 or higher at some point. It's in leg B in the weekly chart. Let me just pull this out a little bit to make sure. Yep, leg B in the weekly chart. And here's the other thing. The daily might have recycled with an instant restart. I'm being a little conservative right now. I'm calling it F/B. But the MACD is very strong, and the stochastics at 89%. This is very good. I would say that if there was a pullback at 84.73 right now, there was a pullback into between the candle of the 13th with the low of 79.30. 81.88 was the high and 79.30 is the low, to this candle right here of the 8th of April with 77.80 low. Anywhere in that area, that's going to be the test to see on the weekly basis, does it hold? Because way down at 77.70 is the 9-period exponential moving average. Now, a couple of things that we want to do right now is I mentioned it earlier right at the very beginning of the show, but let me do this again because I didn't go into it in great detail. The volatility index. So what I did for subscribers over the weekend, I showed them the chart. Remember, we closed right there on Friday. And what I said was, one little close like that is fine. But until you start to see closes above 1416 in the 9-period moving average of the weekly chart, but really it's 1507 in the monthly chart, you want to start seeing not this magnet towards the downside that keeps attracting the VIX index, the volatility index. And remember, I make it as simple as possible. When you see it declining, especially when it goes into the low teens and then to the 12s and 11s, that is buying pressure. When you've got it has a much more complex methodology to it. Has to do with the futures contracts, the nearest month, and the differential between the volatility index, what it's saying, that actual reading. But most importantly, I don't look at it that way. I just look at it real simply, and I say, when the VIX is declining, invariably in the 20 whatever years it is, I've followed the volatility index, it implies that there's buying pressure. And what we saw on Friday, and to me it was very disappointing because we held the volatility shares, when I saw that you went all the way to the upper end of the limit, but you didn't break above 1517, that pinkish 200-period exponential daily moving average, and then push and even close above it, that would have been absolutely imperative to say that there'd be follow-through selling on Monday morning. Instead, what there was a close towards the low of the day. The low of the day, are you kidding me? It was a gap up, I admit that. But that was crazy. When I saw that, I said to myself, this makes the VIX index even more appropriate to follow this week. And we'll be right back. I'll follow up because I want to talk about it in terms of the weekly chart, the patterns that we're looking at. Basil Chapman, Tiger Technicians Hour. We'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. Basil Chapman, Tiger Technicians out. Dow's up 239. S&P's up 21. Comp index is up 58. The VIX index is down 87 cents at 1302. We'll get back to it in a moment. The XLF, I want to do that. XLF is, in fact, up a little bit, up only 15 cents. Yeah, nice move after the terrible shellacking it got off to make a peak D on Friday. But yeah, I would expect more from it at this particular point. We're going on. We're going to look at gold. Gold itself is at 11.92. It's down $11. Now, this is the pattern that I've been looking at. Remember the H pattern? It went from a cup pattern to the arch formation. It's extended a little bit to the right, which says, okay, it's trying to find support, and that support better come in at 1183. That was the low that was made on the 14th. And even more important than that, it's the weekly chart that I drew that arch formation in. And that's a worry to me because, gold could really come back very sharply. If it takes out the 1170 support, that's just not going to be a good thing. So that's in gold. Silver is SI right now. SI is trading, made a peak 1C2 top, and now it's pulling back. Yeah, this is not good action at all. High-grade copper last night was looking fabulous. Giving it all back. Isn't that amazing? You always you always have to wait for the bar to conclude, because the bar, even this morning, I think it opened. Yeah, it opened up right there. It was looking great. And I almost mentioned, whoa, copper's acting well. That's a good sign. And then I thought, you know what? Let the bar conclude for the day. And it hasn't even concluded for the day. We've still got hours to go, and yet look where it is, under the 9 EMA. To me, that's a moment of importance. It's saying that the internals for our economy, which I would like to think of as being registered in the copper, holding very well, trying to get back to the threes instead. Now we're back in the 273 area. Not good. You break to the 265s, and then it'll probably coincide and confirm what I've been talking about for a while, that I think we're in the midst of a shorter term mini recession. Now, high-grade copper gave that doji candle gap to the upside, turn around. Oh, well, there it is. Okay. Now let's continue. This is very important to me. The TLT, not target, but TLT, is holding well. It's not acting fantastically. It's just in this. Remember, a rectangle formation can keep going in a sideways pattern longer than your patience. And look at this. It's just stuck between. And I've been saying that I think yields are not going to break down. They're not going to break up. They're just kind of stuck in this range for now. And that's kind of what we're looking at. Let me just have a look at the other technique that I've got here. I'll look at it on my software, TLT, that I developed. Okay. Yeah, 131.78 on the TLT is going to be strong resistance. 131.62 on the 120-minute chart. And look at that incredible support at the 129.45 that's been there for a while. 128 to 129, a lot of support. So there's more support than there is resistance. We'll watch to see what happens here. But I can tell you this, that if the TLT, the Lehman 20-year T-bond fund, breaks into the 132s and holds, I would not be surprised to see further selling in the general market. Okay, now I wanted to also do that. That's bonds. Let me just do it as bonds. The US, yep, it's the same thing. 166.01 resistance, and 165s, 165 to 167. 165, 166 to 167. Those are the levels that I've got registered here in the Chapman Wave methodology as very strong resistance levels. So yeah, I just think that bonds are in a nice holding pattern. Okay, so we want the dollar, because a lot rests on the dollar, and I think that the Fed, in their mind, would love to see that the dollar gets smacked down, but they don't really want to do it. In fact, I'm not sure how they can do it. They have all these fingers in these different pies. They really can't take the finger out of any one pie because it'll disrupt the whole thing. But I'd say the H becomes a U formation. You remember? A euphemism. That's a euphemism. A euphemism for the W pattern. There it is. And then we're just stuck in that same pattern. So most of the commodity type area are just stuck in these ranges at this particular point. So it's very important. So now I can go back to the VIX index. So this is what I want to do. I wanted to explain. In my methodology, what we're looking at is I look for cluster formations. I look at congestant areas where you've seen a lot of the same color. In other words, the red candles predominate in the VIX. What does that say? If you look at the New York Stock Exchange, this is based on the futures in the New York Stock Exchange, green has pretty much predominated. And it's just filled in that very big island doji reversal from Friday. So this is going to be a very important moment. If you wanted my guess, no. If you wanted my analysis based on my intraday work, my suggestion is that by the end of the day, we'll close much lower than where we are right now. But things happen during the day, and this is what I'm saying, that we will know based on this VIX index. Let me go back to the VIX now. We will know based on this VIX index whether or not the selling is real. In other words, it's institutional, big money is flowing in. It keeps pushing, so that you've got consistent selling in the VIX, which represents the corollary, which is buying in the indices, the stock indices. And if that's the case, then you will not see, if we hold here or close towards the 260s, plus 260 on the Dow, plus 2122 on the S&P. The VIX is going to stay in this level. It could even hit 1283, 1292 to 1283. But if this pattern that I'm looking at here with higher lows, let me double check, 1250. Oh, it made a lower low. Oh, pity about that. All right, doesn't matter. I'll have to deal with that as a different way of the Chapman wave, of reading the Chapman wave. You've gone to a higher high and you now made a higher low. If that is, we've got a caller waiting. All right, oops, I'm sorry, Jim, I didn't see you. So let me go to Jim. Jim in Denver, how are you?
Okay, Basil, how are you doing?
I'm well, except I'm sorry, I covered you up on my screen so that I didn't see that there was a caller waiting. So Jim, what would you like to?
I need to hear everything you were talking about, so good.
Okay, good.
Yeah, I would like you to look at Kroger again. You looked at it a few weeks ago.
Yeah, and that was a pattern that we were looking at. There was a potential. If I remember correctly, I didn't know if it was exactly the pattern that I would expect would unfold, and that is that there was a rectangle to an arch formation. And if I remember correctly, what I said is it's imperative for Kroger, KR, which has been one of the very best in the whole retail food sector, but it's actually in the whole retail and it's the whole market, one of the very best chart patterns. It's only made one peak in the rising monthly tide since February of 2014. So that is over 12, 13, 14 months. And only this month so far have we made a slightly lower high of 77.74 last month to 77.56. It's a potential Chapman wave 2-bar reversal candidate. And what I said is that I believe I said this, that the rectangle formation should continue, but we won't know until I think, if I remember correctly, it was the stock. I think I said until we close above the high that was made at peak D at 77.74, but it needs to be quite a bit higher. It can't just close and then, it can't go above and then close lower. It needed to close nicely above. I have to consider that it's a rectangle pattern, and that at some point the big thing will be what happens when the low of 75.25, the low of the 26th of March gets tested. Well, we've seen that tested. It was tested on the 14th of April, broke under it, and we've had only red candles all the way through to today, with the MACD and stochastic very poor. Stochastic's just getting to 7% and attempting to rally, and it hasn't been able to. So now you're going to have to remind me, what was the story? I think you had a position.
Yes, and you had said that you thought it might pull back to around 72.30 or something like that, and
right,
that it kind of needed to hold that.
Right, and then and the other thing was that my thinking was that if it was a peak E, the way last week's candle, we didn't know at the time, but the way the candle came in was going to be very important to give us information about the monthly chart, and that the monthly chart showed nothing other than the on balance was a little high and it looked like it wanted to turn down, but it was still looking great. Okay, so now what I'm going to ask you is this. I don't like the action of Kroger at all, but it is really close, and it was when mutual funds and hedge funds and the big money candidates see their favorite stock and sector start to come down, that's when some of them step up to the plate and say, this rally should continue, and others step up to the plate and say, I'm not going to do anything, but very few actually sell until key levels are taken out. That's just my impression after years of watching this stuff. And at this particular point, the pullback that occurred from Wednesday started, I bet, to make some of them nervous. Why? Because it took out the gap. They must have been watching the gap from the 5th of March with a low of 72.60, and just the day before, it was trading at 69.65. So this is a very important gap. So here's my thinking. I believe there should be a counter trend rally, and I would only call it a counter trend rally at this particular point in Kroger, KR, trading at 71.86, up 0.03, 0.04%. And I suspect that the rally is going to not be able to hold above the 74.12 to 74.73 resistance. It could get there, but if it might only hold there for a day, maybe a day and a half, and then I think it starts to come back. If it comes back, I don't want any part of Kroger. So here's the thing that I'd be looking at. Let me grab my 120-minute chart. Well, I know that you were looking at this more as not, you didn't mind a short-term trade if it gave you points, but you're really looking at it as a position play to say, this is April. I would like to know that somewhere like the 3rd week of June, 1st week of July, this has been going up steadily, and that it's now at 75 or 76. Doesn't have to go to the new highs, but it's holding very well, and it's an uptrend. I can't actually give you that. I don't have anything right now to say that that could be the case. I do have something that says on a shorter term basis, right here at 71.88 with a 1.5 point stop, I would start a small position, and I would do that, and I wouldn't add to it until Wednesday afternoon before the close. If it's trading above 73.35, that's above Friday's candle, at 73.75, if it's holding well. Thursday, if there's no pullback, but it holds steady like a rock, I would add another small position, and I would treat it as something that I'm looking at that has the potential to, it certainly with the monthly chart has the potential to go back to the 77, 78 level. But boy, it needs to prove itself, because the selling, there wasn't selling pressure, intensity, and volume, but the pattern that's forming in the weekly by that ugly candle of Friday and the stochastic and MACD says you can only expect a bounce. If you want to play it as a bounce, that's the way I would do it. But if you wanted to ask my opinion, what would I do right at this moment? I'd say, you know what? I don't want 2 points in a stock that's done so well. I want much more than that. I'd probably wait the day out, see where it closes, and if tomorrow at any point it goes 1 penny above today's high, then I would start the little nibble. But if it doesn't do that by tomorrow morning, by 12 o'clock Eastern time, I don't think I'd want any part of it. So my analysis based on the fact that the cup formation that I'd already drawn in was pierced decisively, it should have stopped at 73 to 73.20. Instead it went right down to today's low of 71.42. Makes me kind of nervous about the upside potential other than a bounce. Okay. Is that something that you could work with?
Yes, very much. Thanks, Basil.
Okay, now there's another way. Do you ever use options?
No, not in this particular account, no.
Okay, all right. Because
really,
the only thing I would do.
This is a long-term hold is what I was looking at.
Yeah. So do you still have a core position?
Yes.
You see, that's the thing that I was working around that core position. Okay, I mentioned that core position. I would get nervous if that arch formation that I'm anticipating starts to fail. But even if it doesn't do that, if it takes out, I don't want you to get out of a potential bounce at 69, under 69. I think that's what we even spoke about before. But if you're in for the longer term, I'm going to suggest that I'm not going to get you out of that position just on a whim. I want another 3-4 days of action. Give me a call Thursday. Today's Monday. Wednesday afternoon. Yeah, give me a call Thursday. If you're free and you're able to do that, let's look at it again, because I don't want you to give back great gains, but I also don't want you to get out when in fact you've got a position that you've held through thick and thin, and you've done very well. So if that fits into your scenario, let's look at it again Thursday.
Very good. Thanks, Basil.
Thank you so much, folks. We were looking at Kroger. That was Jim in Denver. Thank you for calling, Jim. We'll be back straight after this.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Let me just answer Jay in the dentist. Jay, the Facebook is still looking very good. The monthly chart, just a very steady walk along the 9-period moving average with support at 77.07. The weekly is walking the 9-period moving average of 81.12, and looks like it wants to get to a leg D above 86.07. That's the way it's looking right now. But the daily chart has been really struggling, and that's the one I've been fighting with all the time, because I once owned Facebook way lower. I would like Facebook. I like the leaders of the pack are really what the fund managers are going for. So this looks like if there's an earnings announcement that has anything positive about it, it should break above leg C and continue leg C above 86.07. I'm not calling it G/C for now, although I probably should. It's acting well, that's all. So and all I can say is that if it closes under 80 after the earnings are out, that'll be a negative, but at this particular point, it's holding very well. Let's get back. I wanted to do the VIX index. I hadn't quite finished the VIX index. So this is going to be quite important to me. The weight of evidence thus far says that all these red candles are suggesting that buying pressure is there in the general market. The the way the daily chart of the Dow has gone from a sell mode to a cancellation of the sell mode with each of these big bounces, the bounces have been huge because the declines have been very sharp, but it's all within a trading boundary. So let me just give it to you this way, that if the VIX at 1297 remains in the 12s through Tuesday and Wednesday, there's a real good chance that this market, that the Dow could even have a test of the 18,200s. That's going to be very important. But if by the end of the day there's some kind of selling, because this has just been mostly short covering and the layperson coming in who's really not, the layperson doesn't really establish the rules because they don't have the kind of financial clout. If they are there and the market all of a sudden turns down, instead of being up 236 in the Dow, up 21 in the S&P, we're now down, we're up 16 in the S&P, and we're only up at 165 in the Dow, and there's general weakness, and the VIX actually starts to rally. If it closes again, I don't think it can get above 1344 unless there's some very sharp selling. For whatever reason, if it does close above that level, that's going to say, hey, Tuesday is going to become even more important for the parameters. Let me give you the parameters. Look, on the Dow, what you need to see is 17,987 is the 9-period moving average. A close below that just puts you back into Friday's ambience and ignores everything that positive that happened earlier today. So that's what you want to see. And the S&P is the same sort of thing, SPX.X. If you're looking at the S&P, it's at 2102. It would have to pull back, so the Dow would actually have to drop over 100-something points, S&P over 10 points, and you'd have to get into the 2092 area to go under the 9-period moving average. If that happens, then what we're looking at here is a different scenario altogether. What we're looking at is a reflex emotional response today to other news, external news, but no internal integrity, and that's what you want to see. So the S&P has gone higher than Friday. That's great. What you want to see is the close of Thursday on the S&P of 2104 point, let's call it 2105. A close of above 2105 says, hey, don't ignore me. I'm acting very well. I'm going to, in that weekly chart, I might make a leg D instead of C1, C2, C3. That's going to be very important. So those are the parameters that I'm looking at. New York Stock Exchange actually is the one that over the weekend I sent out the chart to my subscribers. And what I'd said is, these are the parameters, and they're very clear, that it closed under the 9 EMA. But if the weekly chart still continues to hold well, you've got to respect that the New York Stock Exchange is a very big component. So I'll be back tomorrow. Stay tuned for Larry Preservento. Should be a great show with Larry as always, and I'll be back tomorrow. Have a great day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.